Right now, as the market is live, Chipotle Mexican Grill, or CMG, is trading at $33.11 per share. That is not a typo. It is down a catastrophic $6.65, a drop of over 16.73% on the day. The stock just gapped down and hit a new 52-week low of $31.01 earlier this morning. This is what a complete and total evaporation of market confidence looks like in real time. For a stock that has been a darling of growth investors for the better part of a decade, this is a stunning collapse. Many people who follow the market, even casually, are used to seeing Chipotle as that expensive premium stock, the one that always felt just a little too rich but kept climbing. The expectation was that Chipotle was invincible, a tech-enabled food brand that had cracked the code on pricing power and customer loyalty. The reality, delivered in yesterday's third quarter earnings report, is that the armor is not just cracked, it's been shattered. The premium brand has become its primary vulnerability. The core belief was that Chipotle's higher-income customer base insulated it from the inflationary pressures and economic slowing that has plagued the rest of the fast food industry. That belief has just been proven definitively false. What we are witnessing today is a violent repricing based on one single terrifying fact: Chipotle's customer traffic is falling. The company reported its Q3 2025 numbers after the bell yesterday, and while the headline earnings per share of $29 matched estimates, the internals of the report were a disaster. Total revenue came in at $3 billion, which was a miss, but the number that has sent shockwaves through the market is comparable restaurant sales. Comps, the single most important metric for a restaurant, grew by a pathetic 0.3%. That is essentially zero, but it gets so much worse when you look under the hood. That 0.3% growth was driven entirely by a 1.1% increase in the average check, meaning price hikes. The actual number of people walking in the door or ordering online declined by 0.8%. This marks the third consecutive quarter that customer traffic has fallen. The growth story, the fundamental thesis for owning this stock at a high valuation, is predicated on more people buying more burritos. Right now, fewer people are buying. The management team in their earnings call couldn't hide from this. They were forced to slash their full-year guidance for same-store sales for the third time this year. They are now guiding for a decline in the low single digits for all of 2025. They also signaled that the fourth quarter, the one we are in right now, is going to be even worse, with comps expected to fall in the low to mid single-digit range. This is a stunning reversal. This isn't a slowdown. It's a contraction. The company explicitly blamed persistent macroeconomic pressures. The high-end consumer is finally pulling back, but the real damage is coming from the core of their customer base. Management admitted that households earning under $100,000 a year, which make up a massive 40% of their sales, have meaningfully reduced their visits. The data also shows younger customers, the Gen Z and millennial cohort that built this brand, are pulling away, squeezed by the resumption of student loan payments, stagnant wages, and general economic anxiety. This isn't a stock like Apple stock, which sells a product deeply integrated into people's lives. This is a premium lunch, and it's proving to be one of the first things consumers are cutting. This is where the entire investment thesis for CMG breaks down. For years, the bull case was built on pricing power. The joke was that Chipotle could charge $20 for a burrito and people would still line up out the door. Yesterday, management effectively announced that the pricing power is gone. They stated that they will not be able to offset rising costs with more menu price hikes, fearing they will alienate even more customers. The current 2% price increase that's propping up the members is set to roll off in December. This means Chipotle will exit 2025 with effectively zero net pricing. This is a company facing massive cost headwinds from labor inflation and new tariffs on beef, and it just lost its primary weapon to defend its margins. We're already seeing the damage. Restaurant-level operating margins fell 100 basis points to 24.5%. Labor costs rose. Marketing costs jumped. This is a margin compression story, and it's just getting started. The reaction from Wall Street has been swift and brutal. This morning, analysts are racing to downgrade the stock. Goldman Sachs slashed their price target from $52 down to $45. Bernstein and Raymond James both cut theirs to $40. Stifel cut theirs to $50. The consensus is that the premium valuation that CMG has always commanded is no longer justifiable. The stock is trading at a PE ratio that is still, even after this crash, far above its peers. It's priced for perfection in a world that is suddenly deeply imperfect. For the average person engaged in self-investing, perhaps looking at their Robinhood or SoFi Invest account this morning, this is a terrifying sight. This isn't the kind of stock you just park in a Schwab Intelligent Portfolios account and forget about. This is an active, high-wire act growth stock, and the wire just snapped. The volume today is immense. Over 30 million shares have traded, and it's not even midday. This is institutional capitulation. This is Fidelity and other large funds dumping their positions. This is what it looks like when the narrative breaks. So what does Chipotle actually do for those who have only followed the stock? It's a chain of fast casual restaurants specializing in Mexican-inspired cuisine: burritos, bowls, tacos, and salads. Its brand was built on the Food with Integrity motto, promising fresh ingredients and ethical sourcing. This differentiated it from traditional fast food and allowed it to command its premium prices. The company's growth in the last 5 years has been powered by a brilliant digital strategy. Its app is one of the best in the business, and the rollout of Chipotle lanes, drive-through lanes dedicated exclusively to digital order pickups, has been a massive success. Digital sales still account for over 36% of their revenue. But here's the tension. The market fell in love with this tech-forward, digital-first story. It started valuing CMG like a tech company, much like it does with Tesla stock or Nvidia stock, rather than a restaurant that sells chicken and rice. The problem is that when customer traffic falls, it doesn't matter how good your app is. You are still a restaurant, and you are still subject to the economic realities of your customer. There is one and only one bright spot in this entire report: unit growth. Chipotle is still opening new restaurants at an incredible pace. They opened 84 new locations in the last quarter alone, 64 of which had a Chipotle lane. In fact, they are accelerating their opening plans for 2026, guiding for 350 to 370 new locations. This is now the only thing holding up their revenue growth. The company is essentially trying to outbuild its same-store sales decline. This is a classic and dangerous restaurant growth strategy. You can mask a sick underlying business for a while by just opening new stores, but eventually the declining performance of the existing store base catches up to you. This is the new expectation versus reality. The expectation was that growth would come from both new units and from existing stores getting more productive. The reality is that the existing stores are sick and the new stores are just a bandage. Looking ahead, the future for Chipotle is incredibly uncertain. The bull case, if one exists, is long-term. It's built on two pillars. First, that this economic downturn is temporary, and when the consumer feels richer, they will come back to their $15 burrito bowls. Second, it's built on automation. Chipotle has been famously testing their Autovocado, a robot that preps avocados for guacamole, and an augmented make line to automate automate the bowl-making process. These are initiatives designed to permanently fix their biggest problem, rising labor costs. If they can roll these technologies out across their thousands of stores, they could radically reshape their margin profile. But that is a story for 2027 or 2028. That is not a story for today. Fidelity Investments and other managers of large Fidelity mutual funds aren't waiting around for that. They are selling now because the 2026 outlook is in tatters. The risks are far more immediate and clear. The primary risk is that this is not a temporary pullback. This is a permanent shift in consumer behavior. What if the consumer has decided that in this new inflationary world, Chipotle is no longer a good value? The brand has been defined by its premium status, and it may not be able to pivot to a value message without destroying that brand. Competition is also fierce. Kava, Sweetgreen, and countless local fast casual spots are all fighting for that same dollar. And the macroeconomic picture remains the biggest unknown. If inflation stays high and the job market weakens, the sub-100K customer isn't coming back. This is the central question for anyone even thinking about buying this dip, whether it's through Fidelity ETFs that hold the stock or in their individual brokerage account. This leads me to a question for all of you watching this collapse. Comment below with what you think